Silver just crossed $90 for $1. Gold is above 5,250. Diplomacy has stalled, inflation just reaccelerated, and the United States is quietly evacuating personnel from Israel. These are not isolated headlines. They are signals. Signals that capital is moving. Signals that risk is being repriced. Signals that something larger may already be unfolding beneath the surface. When metals rise this fast, it is rarely about excitement. It is usually about protection. And when protection assets move first, markets are preparing for something most people have not yet fully processed. The real question is not why silver hit $94. The real question is, what does it know that the public does not? Welcome to Boring Currency Ledger, where signals are studied before they become crises. If you have lived through multiple economic cycles, if you have watched currencies rise and fall over decades, then you already understand that preparation is quiet, not loud. Consider subscribing, not for drama, but for disciplined analysis. And before we begin, tell us in the comments, which city, which country are you watching from today? When silver moved above $94 per ounce, the market did not celebrate. It reacted. Gold had already crossed 5,250. That alone would have been significant. But when both metals rise together and rise with force, experienced observers do not call it coincidence. They call it confirmation. In financial markets, confirmation matters more than headlines. For months, silver had been testing the $92 level. It approached that price repeatedly, only to retreat each time. Traders saw rejection, skeptics saw exhaustion, commentators suggested the rally was overextended, but markets often test resistance before breaking it. When silver finally pushed through $92 and did not pull back, when it accelerated instead, that was not emotional buying. It was structural demand overpowering supply at a known ceiling. In technical terms, former resistance becomes new support. In strategic terms, a barrier has been removed. The breakout was not a single spike. It came after 10 consecutive green monthly candles. 10 months in a row where silver closed higher than it opened. This type of consistency is rare in modern trading history. Silver is known for volatility. It rises quickly and falls just as quickly. Yet over the past 10 months, each decline was absorbed. Each pullback was met with buyers. That pattern tells a different story than speculation. Speculation is emotional. Accumulation is patient. When large capital accumulates, it does not chase price wildly. It builds positions quietly over time. It allows short-term weakness. It welcomes dips. The chart begins to show a staircase pattern rather than a spike. That is what the monthly structure revealed. Gold confirmed the message. Gold is not a small market. It is deep and highly liquid. It does not move dramatically without institutional participation. When gold doubles over 2 years and then continues higher, that signals something larger than retail excitement. It suggests global capital is seeking protection. Historically, when gold moves first, silver follows with greater intensity. Silver's market size is much smaller. This makes it more sensitive to new flows. A modest reallocation from institutional portfolios can move silver disproportionately. When silver rises 6% in a single session, while gold rises 1%, professionals understand what that means. Capital is rotating into higher beta within the same asset class. The breakout was not driven by a single news event. It occurred during a convergence of geopolitical tension and inflation data. That timing matters. Markets rarely respond strongly to one variable alone. They respond when multiple pressures align. This is what economists call a regime shift. A regime shift happens when the underlying environment changes, not just prices. It is when assumptions that held for years begin to fail. For much of the previous decade, inflation was stable. Interest rates were near zero. Global supply chains were relatively predictable. Investors favored growth assets and long-duration risk. Now the conditions look different. Inflation has proven persistent. Geopolitical tensions have increased. Supply chains have become fragile. Public debt has reached historic levels. Central banks face constraints. In such an environment, hard assets regain importance. Silver's breakout above $94 may appear dramatic, but to experienced capital allocators, it looks like repricing. Markets constantly adjust expectations about the future. When uncertainty increases, the price of protection rises. This is not new in history. During past periods of monetary stress, commodities and precious metals led before broader markets reacted. They functioned as early warning indicators. They signaled shifts in liquidity and confidence before traditional economic data confirmed them. The 10-month climb in silver suggests sustained repositioning. It implies that institutions, not just individuals, have been adjusting exposure. Another important factor is volume. Breakouts that occur on low participation are fragile. Breakouts that occur with expanding participation are durable. Reports from exchanges showed rising open interest and higher trading volume as silver approached $92. When the barrier broke, participation increased further. That is a sign of commitment. Some observers will argue that rapid moves often reverse. That is true in speculative bubbles, but bubbles usually display parabolic behavior without foundation. In contrast, this advance has unfolded alongside documented supply deficits and rising macro risk. The key distinction is between momentum without structure and momentum supported by structure. Silver's behavior over the past 10 months has displayed structure. Every market move tells a story. The question is whether observers are listening carefully. At $94, silver is not merely higher. It is signaling. It is signaling that capital is uneasy. It is signaling that protection is being prioritized. It is signaling that the cost of uncertainty is rising. For business leaders and entrepreneurs, price alone is not the lesson. The lesson lies in what price movement reflects about broader conditions. When protective assets outperform growth assets, it suggests a shift in confidence. The breakout above $94 may eventually retrace in the short term. Volatility is normal in silver, but the larger message is about direction and persistence. Markets do not move 10 months in a straight upward sequence without reason. Something has changed, and the breakout is the first visible confirmation of that change. Geopolitical escalation and the energy transmission mechanism. When diplomacy fails, markets begin calculating probabilities. The third round of indirect nuclear negotiations between the United States and Iran ended without agreement. There was no framework for dismantling enrichment facilities, no timeline for uranium export, no partial compromise. Officials described the discussions as intense, but intensity without resolution. Signals friction, not progress. For market participants, the failure itself was less important than what it removed. It removed the diplomatic off-ramp. In geopolitical strategy, an off-ramp is a controlled exit from escalation. When it disappears, risk pricing changes immediately. Investors no longer calculate the probability of a peaceful outcome. They begin calculating the probability of miscalculation. Simultaneously, the United States authorized the departure of non-emergency personnel and families from Israel. In diplomatic language, that is not routine. Governments operate in layers of warning. Level 1 is advisory language, caution. Level 2 is voluntary departure, permission. Level 3 is authorization combined with urgency, preparation. The added phrase, while commercial flights are available, carried measurable weight. Historically, that language has preceded airspace restrictions during periods of heightened conflict risk. Markets do not wait for missiles to launch. They move when risk probability shifts above a threshold. The threshold is often energy. Approximately 20% of global oil supply, nearly 20 million barrels per day, moves through the Strait of Hormuz. At its narrowest point, the shipping lane is roughly 21 miles wide. Any disruption, even temporary, immediately impacts global pricing expectations. Oil markets react not only to supply cuts, but to risk of supply cuts. In previous geopolitical shocks, even minor threats to the strait have added $10 to $20 per barrel within days. A sustained disruption could push prices substantially higher. At $100 per barrel, inflation pressure intensifies. At $150, it becomes systemic. Energy is not just a commodity, it is an input cost embedded in nearly every economic activity. Transportation, manufacturing, agriculture, logistics all rely on fuel. When oil rises sharply, producer costs rise within weeks. That cost pressure moves into the producer price index before it reaches consumers. That is why the timing of the PPI release matters. January's headline PPI printed at 2.9% year over year. Expectations were 2.6%. The deviation may appear small, but in macroeconomic modeling, a 0.3% miss is meaningful. More significant was core PPI at 3.6% versus an expected 3.0%. A 0.6% deviation in core producer inflation is not statistical noise. It signals that pricing pressure is broad-based rather than isolated to energy or food. When businesses pay more for raw materials and transport, margins compress unless they pass costs forward. Businesses often pass costs forward. For entrepreneurs and executives, this creates dual pressure. Higher operating costs and uncertain demand elasticity. Consumers facing higher fuel and food prices reduce discretionary spending. That weakens growth. At the same time, input costs rise. This is how stagflation risk emerges. The Federal Reserve now faces structural constraints. The federal funds rate has already tightened borrowing conditions. Mortgage rates remain elevated relative to the previous decade. U.S. federal debt exceeds $39 trillion. Corporate refinancing needs are growing. Raising rates further increases debt servicing costs across the system. Cutting rates, while core inflation is above target risks, weakening the currency and accelerating price pressure. This is the policy trap. Geopolitical instability intensifies that trap. If oil spikes because of regional escalation, inflation data will reflect it within months. The central bank would be responding not to domestic overheating, but to external shock. Markets understand this dynamic. That is why gold moved quickly. Gold functions as a hedge against monetary instability and currency debasement. Silver, because of its smaller market size, amplifies that move. The alignment of events matters. Diplomatic breakdown. Evacuation signals. Inflation surprise. Each on its own influences pricing. Together, they alter risk perception. Capital allocation models incorporate scenario analysis. When the probability of energy disruption rises from, for example, 5% to 15%, portfolio adjustments follow. Insurance costs rise, hedging activity increases, commodity exposure expands. This is not emotional behavior, it is mathematical. Global investors allocate trillions of dollars across asset classes. Even a 1% reallocation toward commodities represents tens of billions of dollars. Silver's total above-ground investable value is small relative to gold. Incremental inflows move it sharply. The reaction to $94 was therefore not speculative enthusiasm. It was repricing of geopolitical and inflation risk under constrained monetary conditions. Historically, markets move before official confirmation of crisis. In 1973, oil prices began rising before the full energy embargo took hold. In 1990, crude spiked before the Gulf War began. Investors price risk ahead of events, not after. Today's environment reflects similar characteristics. Uncertainty at a strategic choke point combined with rising producer costs. For business leaders, the lesson is operational, not theoretical. Energy exposure must be evaluated. Supply chains must be stress tested. Input cost hedging must be considered. Silver at $94 is not simply a price milestone. It is a reflection of capital-seeking insulation from systemic variables that are becoming less predictable. When geopolitical friction intersects with inflation data, markets respond decisively, and they rarely respond without reason. Inflation, acceleration, and the Federal Reserve constraint. The producer price index did not simply rise. It disrupted assumptions. January's headline, PPI, printed at 2.9% year over year, above the expected 2.6%. More important was core PPI at 3.6%, compared to forecasts of 3.0%. A 0.6 percentage point deviation in core producer inflation is significant in macroeconomic modeling. It implies pricing pressure is spreading across categories rather than remaining concentrated in volatile components. For business leaders, PPI is not an abstract statistic. It measures what firms pay for raw materials, intermediate goods, transportation, and services before products reach consumers. When producer prices accelerate, companies face two choices: absorb the cost and reduce margins, or pass the cost forward. Most eventually pass it forward. Historically, sustained core PPI above 3% has preceded higher consumer inflation within 2 to 3 quarters. The transmission is not immediate, but it is persistent. Energy, shipping, chemicals, metals, agricultural inputs all feed into final pricing. This creates a layered inflation structure. Layer 1, energy and commodities. Layer 2, manufacturing and logistics. Layer 3, consumer goods and services. The timing of this data release matters because inflation had been trending lower from its peak. Policymakers were signaling patience. Markets were pricing eventual rate cuts. The assumption was stabilization. The PPI print challenges that assumption. Meanwhile, federal debt has surpassed $39 trillion. The annual interest expense has crossed $1 trillion, becoming one of the largest line items in the federal budget. Every percentage point increase in average borrowing cost adds tens of billions in servicing expense. This is not theoretical pressure. It is fiscal arithmetic. Higher interest rates strengthen the currency temporarily, but increase debt strain across households, corporations, and government. Mortgage rates remain elevated compared to the previous decade, contributing to slower housing turnover. Credit card balances have reached record levels while delinquency rates are rising gradually. Small and medium-sized businesses face tighter credit conditions. Refinancing costs are higher. Venture funding has become more selective. Expansion plans require stronger cash flow discipline. Under such conditions, central banks operate with limited flexibility. If they cut rates while core inflation sits at 3.6%, currency weakness may follow. A weaker dollar raises import prices, particularly energy and industrial inputs. That reintroduces inflation pressure. If they raise rates further, borrowing costs intensify across an already leveraged system. This is the constraint. During previous inflation cycles, central banks could tighten aggressively because debt levels were lower relative to GDP. Today, leverage is embedded across sectors. Monetary tightening transmits more quickly into financial stress. Markets understand this dynamic through yield curves and futures pricing. When rate cut expectations fluctuate sharply after inflation data, it signals uncertainty about policy direction. Uncertainty increases hedging demand. Gold historically performs well when real yields, nominal yields adjusted for inflation, decline or become unstable. Silver often amplifies gold's movement because of its smaller market size and dual role as both monetary and industrial metal, but inflation's effect is not limited to metals. For entrepreneurs, the issue is margin compression. If input costs rise 3% to 5% annually while consumer purchasing power weakens, pricing strategy becomes critical. Businesses with strong brand power can pass costs forward more easily. Commodity-sensitive industries cannot. Energy remains the wild card. If oil prices rise even 15% to 20% due to geopolitical tension, transportation and production costs adjust quickly. Historically, a $10 increase in oil can add measurable basis points to inflation expectations. Expectations matter because they influence wage negotiations. When workers anticipate higher living costs, wage demands rise. Wage growth feeds back into service inflation. This feedback loop is difficult to reverse without aggressive tightening. The Federal Reserve's stated target remains 2% inflation. Core PPI at 3.6% suggests distance from that objective. The longer inflation remains above target, the more credibility risk develops. Currency stability depends not only on policy tools, but on trust in those tools. When inflation surprises upward during geopolitical tension, markets reassess defensive allocations. Commodities and precious metals become hedges against policy uncertainty. Silver's movement to $94 occurred within this context. It was not driven solely by geopolitical headlines. It coincided with renewed inflation pressure and constrained monetary response. From a strategic perspective, inflation above expectations reduces planning visibility. Long-term contracts become harder to price. Inventory management requires caution. Capital expenditure decisions must account for higher replacement costs. Entrepreneurs who manage working capital efficiently gain advantage in such periods. Those who rely heavily on variable rate financing face increased vulnerability. Inflation also redistributes wealth. Debtors benefit when inflation exceeds borrowing costs. Savers holding cash experience purchasing power erosion. Hard assets, historically, preserve value during such periods. The market reaction to PPI was therefore rational. It recalibrated expectations. When inflation accelerates while debt levels are elevated and geopolitical risk rises, monetary authorities cannot respond freely. The margin for error narrows. Silver at $94 represents part of that recalibration. It reflects capital hedging against a scenario where inflation proves persistent and policy options remain limited. In financial systems, price is information. The information embedded in recent price action suggests that inflation risk is not fully resolved and that markets are preparing for a period of constrained monetary maneuverability. For decision makers, that preparation must be strategic rather than reactive, because inflation, once embedded, rarely retreats quickly without cost. The physical constraint, supply deficits, concentration risk, and delivery stress. Behind every price move in a commodity, there is a physical balance sheet. Silver's balance sheet has been tightening for several years. According to global industry estimates, annual silver demand recently exceeded supply by approximately 67 million ounces. That means the world consumed more silver than mines produced. The difference was filled by drawing down existing inventories. Inventory drawdowns are not immediately visible in consumer markets. They appear first in exchange data. On the COMEX, the primary futures exchange in New York, silver inventories are divided into two categories: eligible and registered. Eligible silver meets exchange standards but is not committed for delivery. Registered silver is designated and available to settle futures contracts. In recent reporting cycles, registered inventories have declined materially from prior peaks. While total eligible stock may appear stable, the portion readily available for delivery has narrowed. When registered supply shrinks, while open interest in futures remains elevated, the coverage ratio tightens. This ratio matters. If a large percentage of contract holders demand physical delivery rather than cash settlement, the exchange must have sufficient registered inventory to meet obligations. Under normal conditions, most contracts roll forward or settle financially. However, in tight markets, delivery demand can rise. A shrinking registered pool does not guarantee failure, but it increases sensitivity. Simultaneously, silver production is geographically concentrated. Mexico accounts for roughly 25% of global mine output, producing over 200 million ounces annually in recent years. That concentration creates exposure to local instability. Mining is not only about geology. It depends on labor access, transportation routes, permitting stability and security. Any disruption, whether regulatory, logistical, or security-related, can reduce output or delay shipments. Even a 5% to 10% disruption in a major producing region can shift global balances in a deficit environment. China represents another structural variable. As one of the largest producers and consumers of silver, China has increased emphasis on strategic materials. Reports indicate tighter export licensing and internal prioritization for industrial use. Silver plays a key role in solar photovoltaic panels, electronics, electric vehicles, and military systems. Global solar installations have expanded significantly in recent years. Each photovoltaic panel requires silver paste for conductivity. As renewable energy capacity grows, industrial silver demand rises structurally. Unlike gold, which is largely held as a store of value, silver is consumed in manufacturing. A portion is recycled, but recovery rates vary. When industrial demand grows while mine supply stagnates, deficits widen. Recycling alone cannot close persistent gaps quickly. Scrap supply responds to price incentives, but the pipeline is limited by collection and processing capacity. Another factor is above-ground inventory distribution. Much of the silver stock is held in private vaults, industrial inventories, or long-term investment holdings. Not all inventory is liquid or available for immediate market supply. This creates a distinction between theoretical supply and accessible supply. When investors observe rising premiums on physical coins and bars relative to spot prices, it suggests localized tightness. Premium expansion often indicates retail demand exceeding short-term distribution capacity. Premiums are not the same as futures prices. Futures reflect expectations and leverage. Physical premiums reflect immediate availability. Historically, during previous bull cycles, divergence between paper price and physical premium widened before major repricing events. Silver's market capitalization is modest compared to many global asset classes. Estimates of total above-ground investable silver range between 150 to 200 billion, depending on price assumptions. By comparison, the gold market is valued in the trillions. This scale difference magnifies inflow effects. If institutional portfolios allocate even a small percentage towards silver as a hedge, the inflow relative to total market size is meaningful. Unlike currencies, silver supply cannot expand rapidly in response to demand. Mine development requires years of exploration, permitting, financing, and construction. Short-term supply elasticity is low. When demand rises quickly, price becomes the balancing mechanism. A 67 million ounce deficit against global annual production of roughly 800 to 850 million ounces represents a material percentage gap. Over multiple years, cumulative deficits deplete exchange inventories and private stockpiles. This is how structural tightness builds quietly. Futures markets can temporarily mask imbalance because leverage allows large notional exposure without immediate physical movement. However, if confidence in paper settlement weakens, demand for delivery increases. Delivery stress does not require total inventory exhaustion. It requires imbalance between immediate demand and readily available registered stock. For business leaders observing commodity markets, the lesson lies in supply chain resilience. Concentration risk in one or two producing regions increases vulnerability. Strategic stockpiling by large economies reduces global liquidity. Industrial demand growth tightens competition between investment and manufacturing users. Silver's rise to $94 reflects more than geopolitical and inflation concerns. It reflects awareness of constrained supply meeting persistent demand. Markets tend to price scarcity before it becomes visible in retail channels. When inventories decline steadily in a deficit environment, repricing becomes less about speculation and more about physical arithmetic. Supply fragility rarely announces itself loudly. It reveals itself gradually through inventory data, premium expansion, and repeated price floors that refuse to break. Silver's structural deficit, concentrated production, industrial expansion, and tightening registered inventories together create a framework of vulnerability. Price, once again, is the signal. And the signal suggests that physical constraints are no longer theoretical. They are measurable. Ratio compression, scenario modeling, and strategic capital repricing. When gold and silver rise together, professionals do not only look at price, they look at the ratio. The gold to silver ratio measures how many ounces of silver are required to purchase 1 ounce of gold. At present levels, with gold around $5,050 and silver at $94, the ratio sits near 55 to 1. Historically, that number carries information. Over the past century, the long-term average ratio has fluctuated widely, often between 40.1 and 70.1. During periods of financial stress and monetary expansion, the ratio has compressed sharply. In 2011, during the last major precious metal surge, it fell near 30.1. In earlier historical periods, including parts of the 20th century, it moved closer to 21. Ratio compression means silver outperforms gold. If gold remains at 5,250 and the ratio compresses to 30.1, silver would price near $175 per ounce. If it compresses to 20.1, the implied silver price exceeds 260. These are not predictions. They are arithmetic outcomes. For capital allocators, ratio analysis provides a framework for relative value. When gold begins a sustained move, silver typically lags initially and then accelerates. This is due to silver's smaller market size and higher volatility profile. Gold's total market capitalization is estimated in the trillions of dollars. Silver's investable market is a fraction of that, closer to low hundreds of billions. A modest percentage reallocation from gold into silver can create disproportionate price impact. Institutional asset managers monitor such relative valuations carefully. Now consider the broader macro landscape. Global central banks have been net buyers of gold in recent years, adding hundreds of tons annually to reserves. This trend reflects diversification away from currency exposure and geopolitical hedging. When sovereign institutions accumulate gold at scale, they anchor a floor under the broader precious metals complex. Silver benefits indirectly from this institutional floor. At the same time, silver has industrial demand exposure that gold does not. Renewable energy installations continue to expand globally. Photovoltaic capacity additions have grown year after year, and each solar module contains measurable grams of silver. Electric vehicles, consumer electronics, and military technologies all require conductive materials. This dual demand structure, monetary and industrial, amplifies silver's cyclical sensitivity. When economic growth is stable and inflation rises, industrial demand supports price. When growth weakens but monetary expansion increases, investment demand supports price. Few assets benefit from both dynamics simultaneously. This is why ratio compression phases often occur rapidly. From a scenario perspective, three broad pathways can be modeled. Scenario 1, controlled de-escalation. Geopolitical tensions ease. Energy markets stabilize below extreme thresholds. Inflation moderates gradually but remains above target. In this environment, gold consolidates gains, and silver continues moderate appreciation, supported by structural deficits. Ratio compression may proceed slowly toward 40:1 over several quarters. Scenario 2, prolonged tension and sticky inflation. Energy remains elevated. Inflation prints above expectations intermittently. Central banks delay aggressive rate cuts. Investor demand for hard assets persists. Under this scenario, ratio compression accelerates toward the historical 30.1 zone. Silver's price volatility increases, with sharper swings but upward bias. Scenario 3, escalation and policy shock. Energy supply disruption or significant financial instability emerges. Inflation expectations jump while growth slows. Monetary authorities are forced into reactive policy. In such an environment, both gold and silver could reprice sharply. Ratio compression below 30.1 becomes plausible as capital seeks higher beta exposure within precious metals. Each scenario involves uncertainty, but the underlying structural facts remain constant. Global debt levels are elevated, inflation remains above long-term targets, energy choke points exist, silver supply is in deficit, production is geographically concentrated. For entrepreneurs and capital managers, the key insight is not the exact price target. It is the recognition that volatility is intrinsic to repricing phases. Silver has historically moved in large percentage swings during bull cycles. In 2010, 2011, it advanced more than 100% within a year before correcting sharply. Such behavior reflects liquidity dynamics in smaller markets. Risk management, therefore, becomes essential. Position sizing, liquidity reserves, and diversification must be considered. Allocating to silver as part of a broader hedge strategy differs from concentrated speculation. The market's recent move toward $94 reflects early-stage ratio adjustment rather than terminal exhaustion. The ratio, near 55:1, remains elevated relative to prior compression cycles. If gold's structural drivers remain intact, central bank buying, currency diversification, and inflation hedging, silver's relative valuation may continue to adjust. In capital markets, revaluation often occurs in stages. First, gold moves. Second, silver follows gradually. Third, acceleration begins as ratio compression gains attention. Price discovery during such phases can be nonlinear. For decision makers, the lesson lies in probability management. When structural deficits align with macro instability and ratio metrics signal relative undervaluation, repricing risk skews asymmetrically. Silver, at $94, is not only a number. It represents a data point within a broader mathematical framework of ratios, supply constraints, and capital allocation flows. Markets do not compress ratios arbitrarily. They compress when capital decides that relative value no longer reflects underlying risk. And current conditions suggest that reassessment may still be unfolding. Strategic positioning. What this means for capital, businesses, and the next cycle. When markets reprice hard assets, they are not sending a trading signal, they are sending a macroeconomic message. Silver at $94 and gold above $5,250 represent more than momentum. They reflect a shift in how capital evaluates risk, currency stability, and long-term purchasing power. For entrepreneurs and business leaders, the question is not whether silver reaches $120 or $150. The question is how to position balance sheets in an environment defined by federal debt exceeding $39 trillion annual interest expense, above $1 trillion core producer inflation at 3.6%, persistent global supply chain fragility, concentrated commodity production risk. Elevated geopolitical exposure at key energy choke points. These variables influence operating decisions. First, consider purchasing power. If inflation remains above the Federal Reserve's 2% target for an extended period, real cash returns decline. Holding excess liquidity without yield protection becomes costly. Over 5 years, even a 3% average inflation rate erodes approximately 14% of purchasing power. For companies with large cash reserves, this is not trivial. Second, consider energy sensitivity. Approximately 20% of global oil flows through the Strait of Hormuz. Any sustained disruption could push crude prices sharply higher. Historically, a $20 increase in oil can materially affect transportation, packaging, and production costs. Businesses dependent on logistics must model fuel sensitivity scenarios. Hedging contracts, diversified suppliers, and regional sourcing strategies become critical under such volatility. Third, consider input cost exposure. Silver itself is an industrial metal. It is embedded in solar installations, electronics, electric vehicles, and medical equipment. Rising silver prices increase component costs in these sectors. For manufacturers, procurement planning becomes essential. When commodities rise structurally, long-term contracts may need renegotiation. Inventory strategies may need adjustment. Fourth, consider capital allocation frameworks. During stable monetary regimes, growth equities often outperform. During inflationary or uncertain regimes, real assets and pricing power businesses gain relative strength. This is not theory. It has been observed across cycles. In the 1970s, commodities and tangible assets outperformed while real returns on cash and bonds were pressured. In the early 2000s commodity cycle, metals and energy equities led global markets for several years. Regime shifts change leadership. Entrepreneurs who recognize regime transition early can adjust exposure. That does not mean abandoning growth. It means incorporating hedges and resilience into capital structures. Fifth, consider leverage. In high debt environments, rising rates or volatile inflation increase refinancing risk. Companies with floating rate debt are more exposed than those with fixed long-term financing. Strategic debt restructuring during periods of relative calm can reduce vulnerability during stress. Macro instability often rewards conservative balance sheet management. Silver's movement is a signal of capital seeking protection against uncertainty in monetary and geopolitical systems. It does not guarantee crisis. It indicates rising probability of instability. For investors and business owners above 50 years of age, the memory of prior cycles provides perspective. They have seen inflation erode savings. They have seen currency volatility alter purchasing power. Hard assets function as insurance in such environments. For younger entrepreneurs, this cycle may be their first experience with sustained inflation and global tension occurring simultaneously. Understanding historical precedent becomes essential. Hard assets should not replace productive investment. But strategic allocation toward assets with limited supply and global liquidity can reduce exposure to currency debasement. Silver's market capitalization, roughly $150 to $200 billion in investable form, is small relative to global equity and bond markets. Even incremental institutional allocation can shift pricing materially. Gold's market size in the trillions provides depth and stability. Silver provides volatility and torque. Together, they reflect monetary hedging behavior. The broader takeaway is not about metal alone, it is about preparation. Periods of systemic repricing tend to reward those who maintain liquidity, discipline, hedge energy exposure, manage debt proactively, diversify supply chains, protect purchasing power, and they penalize those who assume stability will return automatically. Markets do not move 10 consecutive months upward in a volatile commodity without structural drivers. They do not break long-standing resistance levels without capital conviction. Silver at $94 is therefore a marker. It marks a phase where capital is reassessing inflation durability, geopolitical fragility, and policy constraint. For decision makers, the strategy is not reaction. It is anticipation. The next decade may not resemble the previous one. Debt levels are higher. Supply chains are more complex. Energy transitions are underway. Monetary flexibility is narrower. In such an environment, resilience becomes a competitive advantage. The lesson of this moment is simple but serious. When protection assets rise persistently, it is rarely about excitement. It is about preparation. And those who prepare strategically, rather than emotionally, tend to navigate regime shifts with greater stability than those who dismiss early signals. Silver's rise is one such signal. The responsibility now lies in how it is interpreted and how leaders choose to respond.